anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1, and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has a big high price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says,
"Something remarkable happened in the silver market while the majority of the financial world ignored it. Silver saw an abrupt and forceful sell-off during a thin, illiquid trading window. Many experts, like Andy Schectman, think this was a planned rather than natural move. Schectman claims that this was a calculated takedown, intended to instill fear, shake out weak hands, and conceal the true story taking place behind the scenes rather than a typical market drop. Physical demand skyrocketed while paper prices collapsed. Inventory is tightening, vaults are being depleted, and sovereign entities, the same ones that publicly profess disinterest, are covertly amassing at reduced rates. According to Schectman, this is a concerted attempt to conceal silver's actual worth until the accumulation stage is finished. He claims that what is currently taking place is preparation for a long-term change in the global monetary order rather than manipulation for immediate financial gain." Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
well, you can see the reaction by doing it the other way, dumping it, the reaction that it has. It's, oh my gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where at the same time you have one of the largest short positions ever on SLV. Over 80 million shares are naked short. To affect this, there's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And, again, Think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being a problem, I think, are missing the picture. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery an immediate contract in October.
According to Schectman, the recent drop in the price of silver wasn't a normal market movement. It was planned. It would have been normal for the market to go down a little after 9 weeks of gains, but what actually happened was much more suspicious. During the thinnest and least liquid overnight trading window, huge sell orders were dumped into the market. No rational trader would do this unless they wanted to shake investor confidence, trigger automated stop losses, and cause panic. Schectman claims that this attack reveals a more serious financial issue. The US government increased its debt by $1 trillion in just 71 days, bringing the total to over $38 trillion. The biggest federal expense right now is interest payments alone, and that doesn't even include the trillions of dollars in unpaid promises like Social Security and Medicare. Paper prices, however, do not reflect the reality of the physical silver market. Nearly 38 million ounces of silver were delivered this month, which is one of the highest totals ever recorded, according to COMEX data. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
So what was interesting to me about it as well was some of I think it's Michael Lynch, I think is his name. I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Thursday and Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market. Period. No one would ever do that. They did. And it's done for effect. Specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night or, after New York trading. That would change the outcome. I think it invalidates valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1 and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional. And if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high price newsletter. I think it's north of $10,000 a year for institutional traders. And also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25-25-25-25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this. And all of a sudden they come in and buy over 600,000 ounces, where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. Well, yeah, and that's why you're seeing, as an example, China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the SIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using SIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor, and the next vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in just 71 days, we at 100 billion a week. How long can that go on?
Andy Schectman goes into great detail about how intentional manipulation rather than natural market forces caused the recent collapse in precious metals, particularly silver. He explains that during one of the thinnest trading windows after New York closed and before Asian markets opened, huge quantities of metal contracts were thrown into the market at a time when liquidity is almost non-existent. Under such circumstances, no rational trader would ever sell unless the intention was to drive prices lower and start a domino effect algorithmic selling. Schectman claims that this was done to incite panic and temporarily lower prices, not for financial gain. He cites analyst Michael Lynch, who saw this trend and pointed out that two of the largest financial firms in the world, Morgan Stanley and Bank of America, intervened to purchase substantial quantities of physical gold and silver at those manipulated low prices, right after the planned price decline. In particular, they took immediate delivery of contracts rather than waiting for later months, and they bought over 600,000 ounces of gold. This is especially telling, according to Schectman, because both organizations were once gold sellers. He links this change to the general decline in confidence in the US dollar system. China and other nations are developing their own financial systems in order to completely avoid using the dollar. The Shanghai Gold Exchange allows countries that trade with China to instantly convert yuan into physical gold after accepting payment in yuan. By doing this, the yuan is essentially indirectly backed by gold, opening up a new trade channel independent of the dollar. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.